Hello guys, good afternoon. This is Abid Khan and you are watching Karachians Academy YouTube channel. So here we are doing IGCSE past paper. So we have done in our last videos till 11 11 questions. So today we will start from 12. So we are doing IGCSE past papers and paper accounting paper code is 0452, paper 1 and variant 2, year 2021, attempt October November. So we have already done 11 questions, so we will start from question number 12. So quickly move on to question number 12 and see what question 12 says and what it asks. Okay, so this is your question number 12. A bank statement of a business, and this is bank statement which is not maintained by the business, it is maintained by the bank, and we get it from bank. It is bank record. Bank statement is bank record, it is not business record. Of a business had a credit balance of 2690. You keep a debit balance. Bank is your asset, but for bank you are your amount laying there is a liability. They have to give you back. So bank always appear debit in your cash book and in your books of account, and in bankers books it appears as credit. So the credit balance is 2690 on 1st October 2021, right? At that date checks totaling 850, these are the checks, had not yet been presented for payments. Okay, so what is actually, these are 850 checks, dollar checks of total $850. These, you as a businessman, your business has issued these checks as a payment, right? But they are not appearing in the bank statements. So right now, what is bank statement balance? If you see, it is 2690, and you have already issued these. So you already have deducted them from when you issued these checks. You made an entry of your creditors. You credited the creditors with 850, different various creditors, trade payable account, and 850 you, when you issue the check, you recorded in your book. 850 you already have recorded in your book, but bank has not recorded. Bank has 2690. When this 850 will appear in bank after 2 or 3 days, then this will be deducted, and at that time bank balance will become 2690, right? So bank balance would be this, 800 and just hang on. Yes, it is 2690 is the current balance. When this 850 will appear, this balance will change to 1840. So after 2 or 3 days, when checks will present into the bank, the balance will get reduced. But in your book you already have done it, right? So it means your books are showing showing the effect of. So in your book, your cash book is showing balance of 1840. Currently your books are showing this, and bank books are showing this 2690. But after 2 or 3 days, when these checks will present, bank balance will also become 1840. So your books balance is 1840 because you already have deducted this 850. What was the bank balance in the cash book on first? 840 credit. This is not possible. What he's saying in cash book. So cash book you carry debit balance. He's saying credit balance. So this is wrong. debit at 40 at 1840, yeah, this is correct. 3450, this is incorrect. 3450 debit credit. So your answer is B. Move on to question number 13. What question 13 says? Okay, a trader has purchased a new business premises. Okay, a trader has purchased a new business premises. Okay, what are the example of capital expense? Very simple question. What are the example of total heating and lighting the new premises? This is running cost, right? And this is, you can say, revenue expenditure. So this is not, it is not, it is this one is incorrect. Cost of purchasing the equipment, capital expenditure, yeah, this is capital expenditure. Legal cost of purchasing the, when you buy some equipment, any legal cost paid on that equipment, and any non-current asset, when you incur it, and when till the time that non-current asset or a fixed asset, whatever you say, it could be your building, it could be your plant and machinery, till the time it comes into operation, successful operation, it starts operating, till that time whatever the cost you are incurring that on that non-current asset to bring that into the running situation or in a commercial production status, so all expenses will be treated as capital expenditure, right? So legal cost, this is a capital expenditure. Office furniture purchased for use in the premises, this is also. So 2, 3 and 4, 2, 3 and 4 are your capital expenditure. This one is wrong, right? So 2, 3, 4, 2, 3, 4, 1, 2, 3 and 2, 3, 4, this 2, 3, 4. 13, answer is C. Move on to question number 14. Two companies each purchased a motor vehicle of 10,000. There are two companies, okay. Beginning of year 1, okay. Company G, one is company G, use the straight line method. This company uses a different method, and at 10% is the rate of straight line method per annum, while company H, this is a second one company, and it uses a second method of reducing balance method, 20%. Both the companies have the same equipment of same value, but their depreciation method is different. So how this will affect? What was the difference in the depreciation charge between the two companies? One company G is maintaining a different rate of depreciation, the same vehicle, and the same vehicle of the same cost. Another company is maintaining on different. So we have to differentiate how much would be right. Question 14. So what was the difference in the depreciation? So this is very simple. This is company G and it is H, and you in year 1 you $10,000. So $10,000 is the cost of the equipment for G and H both, right? We can say this G is charging straight on a straight line method 15%. So 15%, if you calculate 10,000, 15% would be 1,500, right? Okay, and how much? So depreciation, and this one is on straight line. So in straight line, this 1,500 till his whole life will remain at 1,500, right? So 1,500 will be a constant, there will be no change. So in the year 2, if we say year 2, so even in year 2 this will be 1,500, because in straight line method you calculate depreciation for a year, and same depreciation is charged till the whole life of the asset, right, on the original cost, right? But in reducing balance, okay, in reducing balance 10,000, if you multiply by 20%, so this will be 2,000. So 2,000 will be your depreciation in company H, right? So there is a difference of 500. When the next year will come, so this 2,000 the total cost is 10,000 minus 2,000, this will become 8,000. And G uses the straight line, and H uses the reducing. So total cost is 10,000 minus 2,000, so his reducing value for the next year would be 8%. If you work out 20%, then this will be 8,000 into 1600, right? You already have studied depreciation method in reducing balance. In the earlier year, you charge higher depreciation, and with the passage of time, your depreciation charge under the reducing balance method, actually it is reducing by every year. So from 2000 to 1600, next year this will further reduce. Now how much, what is the question, what was the difference between the depreciation charge between two companies in year 2? So this is very much clear. G has 1500, it has 1600. H depreciation is higher by 100 than the G company. So this is the difference. 100, G is lesser than H by 100. So A 100 greater for G? No, G is not greater by 100, it is lesser by 100. So this one is wrong. 100 greater for G, $100 greater for G? Yes. For H? Yes. For H, H is 100 greater than G, though this is quite okay, and this is, it seems correct. 500, no, there is a difference of 100, so this 500 is inapplicable. Difference is 500 for H, both are inapplicable. So this is also wrong, this is wrong. The correct answer is 14. Option B is your answer. Move on to next question. Question 15. Okay, move on to next question. Question 15. At the end of the financial year, Mu had prepaid a rent of 1500. Okay, and when it is financial year end, okay, 1500. How should she record this? So Mu is had balance of 1500 in rent. So this is prepaid. You know, we made the prepaid rent account when one account is maintained. If you have a opening balance, debit balance, brought forward balance is, I say, 1000. This is brought down. If brought down means it is your prepaid, it is asset. But if balance brought down is 1000, credit balance, it means this is outstanding, you have to pay, this is your liability, right? What it is saying is, at the financial year end, when the year ended on 31st, she said prepaid was 1500. So prepaid 1500 is only possible when you have on the debit side more, and then you, I say, this is some rent you paid bank by 16,500, right? And you charge to income statement 15,000. Ultimately, this will be 17,500. 17,500. If you deduct this 17,500, then balance, your debit balance will be brought down. CD hoga, this will be CD 1500. So your asset will appear on the credit side, but it is a debit balance. For next year, this will appear as 1500 brought down, right? So when the prepaid rent, this will appear on the credit side. Credit side you will credit by 1500, and this will be your debit. Okay, what he says, let us see. How should she record? Credit 1500 in the rent account. Yes, it is okay. And carry down as credit balance, no, this is wrong. Carry down as a debit balance, right? So this is wrong, so it means it is wrong. Credit 1500 with the rent account, yes, we will credit, this is okay. And carry down as a debit balance, yes, it is carry down as a carry down or brought down as a debit balance, so this is correct. So this option is correct. Debit 1500, no, this will not be, where this is incorrect. Debit 1500, this is incorrect, this will not be debited, you will not debit it, you will credit it, right? So this is incorrect. Your correct answer is B. 15, question 15, answer is B. Move on to question 16. Okay, let's see what question 16 says. Okay, after preparing draft financial statements at the end of her financial year for trading, Lucy discovered two errors. Actually, you see, she has already made her financial statement, right? Just 1 minute. Okay, she already has made her financial statement and she has come up with a draft trading profit. So, but after calculating this, she got to know two errors. What? Damaged inventory had been valued at cost. There was some inventory damage and its cost was 340. When you included that 340 cost as a closing inventory, it was expected to sell at 180 because this was the damaged one. So you know, as per International Accounting Standard IAS 2, so you have to maintain your inventory, you have to value your inventory at the lower of cost or market net realizable value. What you do? The lower of cost or NRV. Cost means it actual cost, and NRV means at which it can be sale at the replacement cost. So it can be it is the realizable value. So if you go into the market and you realize it, you sell it. So at what cost you can? So the lower of either cost is low, you have to, if the cost is low and NRV is high, you have to take cost and you have to avoid NRV. But if NRV is low and cost is high, then you have to consider NRV. So its NRV is, this is NRV, and in your profit you have taken this one. So actually what you have done, 340 you took the inventory and actually you were to take 180. How much you have increased the inventory, closing inventory? By mistake you increase the closing inventory by 160, overstated. You have overvalued and overstated the inventory. And a very simple logic and very simple thing is, where if you increase your closing inventory, you will increase your profit. If you understate your closing inventory, you will understate. So closing inventory has a direct impact on your profit. It has a direct relationship. So here you have increased, it means by $160 you increase the inventory, means you overstated the profit. Okay, this one is clear. 100 items which had been expected to sell for 12. There are 100 items, right? Oh, this is it is they are units, 100 units of anything, and every unit cost was 12, had been valued at their cost price 7. So this is very much clear. Though we do not value inventory on the sale price, it is on the cost price or NRV, whichever is lower. So the cost price was 7. Okay, so carriage inward for each item had not been included in the cost. So here the cost was 7 into 100, 700. So you included this in the closing inventory, right? Actually there was 1 rupee on every 100 as a carriage inward, which was 100. Your actual inventory was 800. You were to record inventory by 800. You have understated, means $100 you understated inventory, closing inventory. It means $100 you understated your profit. So here you overstated the profit by 160. Here you understated the profit by 100. How much? 60 is net overstatement. The net overstatements is 60. So what was the effect of these errors on the gross profit? So on gross profit, overstated by 60, right? Overstated by 60, 100, 60, 160. It looks fine. Overstated by 240, no. Or understated by 60, no, it is not understated. 160 overstated, 100 understated, net overstatement is 60. So this is incorrect. Understated by 240, this is incorrect. Your correct answer is A. We have done with question 16. So guys, thank you very much, and that's all for today. So in our next lecture, we will do question 17. Hope you have enjoyed this video. Please, if you have enjoyed it, then please like it and share it with other students, and also subscribe our channel to get all the latest updates on past paper. Thank you very much, and bye for now.